Hey everybody, welcome to the Portico podcast. This is Mike Casey, the founder of Portico Advisors LLC, and in today's episode, I speak with Weijian Shan, the chairman and CEO of PAG, a leading Asia-focused private equity firm with about $40 billion of assets under management. Prior to PAG, Shan was a co-managing partner of TPG Asia, formerly known as Newbridge Capital. It was a real honor to have Shan on the podcast, as his life story is remarkable. If you haven't read his memoir, Out of the Gobi yet, I heartily encourage you to do so. It's an extraordinary book that recounts Shan's experiences during the Cultural Revolution, particularly the 6 years he spent doing hard labor in a re-education camp, as well as the transformative impact that the normalization of U.S China relations and Deng Xiaoping's economic reforms had on China generally and on Shan in particular. And he's just written a new book called Money Games, which details the rescue of one of Korea's largest banks on the heels of the Asian financial crisis. I reached out to Shan after finishing Money Games because, in addition to providing one of the few narratives to detail a private equity transaction from sourcing through exit, I think his book offers tremendous insights into the art of private equity deal-making, and I wanted to explore some of the themes that his book raises. In addition to his books, Shan and I discussed the importance of stakeholder analysis when structuring private equity investments, whether there is a problem of too much debt in the Chinese economy, SOE reform and the prospects for China's economic rebalancing toward domestic consumption, and his advice for younger people who wish to pursue a career in private equity, among other topics. Shan's thoughtful comments prompted me to rethink some of my own analyses and assumptions. I really enjoyed this conversation, and I hope you will too. Shan, thank you for coming on the Portico podcast. It's an honor to be speaking with you.
Well, thank you very much for having me.
My pleasure. You know, your life story is genuinely inspirational, and your memoir, Out of the Gobi, recounts your journey through 6 years of hard labor in a re-education camp to become a professor at Wharton. You know, it's a really powerful book, and I strongly encourage listeners to buy a copy of it and read it over the holidays. But for those listeners who may not be familiar with your story, I wondered if you'd be willing to take a few minutes up front just to share how you went from the Gobi to leading one of the most prominent private equity houses in Asia.
The book is mostly a recount of a special period in the Chinese history. I would say a very dark period of Chinese history. And I think it is very important to remember that part of the history. And in fact, without knowing that part of history, you can't really understand China today. It is a period when many people, several generations, were deprived of the opportunity to go to school. I finished elementary school at the age of 12. Then for the next 10 years, there was no schooling, and therefore I never received a secondary education. Instead, I spent many years as a hard laborer in the Gobi Desert, but I was not alone. I was with my peers, many people of my generation, and that was quite characteristic of the lives of the people during that period of time, which was not too long ago. It was only about 40 years ago. So I think the book would let the reader understand what China went through during that period of time, how it emerged from that dark age into a different world, which really just happened after Mao died, and how China converged at some point with the United States, which enabled me to go to America to study. So that's what the book is all about.
Yeah, it really is an extraordinary book. And as you rightly mentioned, you know, Out of the Gobi takes us up to your professorship. But your new book that's just come out, Money Games, touches upon your career as a banker and an investor. And it does so through the prism of a landmark transaction, which is the rescue of a major Korean bank. I wondered if you could just set the scene and tell us how this opportunity came to your attention and why your team found it so attractive.
Mike, I think maybe I should say a few words why I wrote this book in the first place. I
Please
think
do.
there's a lot of interest about private equity, but I think there's very little understanding about private equity. And to a large extent, private equity remains a mystery. At least there's a dearth of literature about how private equity firms operate. There were a few books like Barbarians at the Gate, talking about KKR's acquisition of RJR Nabisco back in 1988. And the book quickly became a bestseller and was made into an HBO movie, which was very popular as well. But the book, written 1 year after the deal was put together, dealt only with the deal-making part of that particular transaction. Henry Kravitz of KKR likes to say, any idiot can buy a business. It is what happens to the business afterwards that really matters. It is how private equity actually makes money or loses money that really matters. So my book, different from other literature on private equity, covers the entire investment cycle from negotiating the deal to making the investments to turning around the institution, which was once the largest bank in Korea, to final exit, how we actually made money. So I think the book fills a void in the literature on private equity and allows people to better understand how private equity works. And with regard to your question, how we seize upon this particular opportunity to acquire what used to be the largest bank in Korea in the middle of the last Asian financial crisis that happened in 1997. It was really not my decision. It was not really my thinking at the time because I was new to private equity. In fact, I just joined Newbridge a short while ago at that particular point. And Newbridge was TPG's franchise in Asia. Later, we changed the name of Newbridge to TPG Asia. When we received the invitation to buy or to compete with others to buy what used to be the largest bank in Korea, but failed, and it was nationalized by the Korean government, I was very skeptical and I was very dubious. I thought, who would buy a failed bank in a failed economy? This was in the depths of Asian financial crisis. At the worst time in the crisis. So that was the first thought that I had. But David Bonderman, the senior partner, the founder of TPG, and my mentor, said, well, the history of life shows that if the deal is structured correctly, this is as good time to buy a bank as ever. And of course, he did the acquisition of American Savings Bank about 10 years earlier and made tons of money from it. So he was very experienced in this regard. It was his idea for us to look into it. And that was the start of my journey to Korea to negotiate, to acquire the bank that I described in the book.
So picking up on that thread that you dangled there at the end of showing up for the negotiations, Money Games details a marathon series of negotiations that had many false dawns, and I'll spare the details so readers can enjoy them for themselves once they snag the book. But just getting to the memorandum of understanding was a Herculean task, and it took much more negotiation to finalize the deal. What gave you the confidence to keep pushing through? And I wonder, were there any points when you felt that the opportunity costs of pursuing the deal were too high to merit your continued energy?
We had doubts. In private equity, one virtue is to be able to walk away. You don't want to be fixated on a particular transaction, if the chances of success are not very high, and you certainly don't want to push yourself too hard to pay, for example, a price that would not allow you to make good returns for your investors. We never did that. And we could have walked away as negotiations got very difficult. But I thought if a deal happened along the lines of the terms which we proposed, it would have been a very good deal for our investors, who we call limited partners. So I thought that as long as the other side was willing to continue to negotiate with us, we should engage and see what happened. So I think that part of that tenacity came from my days in the Gobi. I thought nothing could be tougher. And in fact, I remember one reporter of the Wall Street Journal in Hong Kong joked with me at the time that she would take away my passport so I could no longer fly to Seoul to negotiate for this particular transaction. Of course, it was just joking, but it did take a very long time. But there were ups and downs, there were many turns, there were hopes, and there were disappointments, which made the story, I suppose, more interesting.
Absolutely. One of the points that I took away from your negotiations in money games was the need to be cognizant of stakeholders' interests when structuring deals. And in the case of the bank, you were trying to orchestrate a deal that was not only attractive to Newbridge and your investors, but also to the Korean government and the company's employees. And you mentioned Barbarians at the Gate earlier, and I must say that this book runs counter to the stereotypical image of a buyout firm as you get with the KKR deal in Nabisco. And I guess just a general question, how important is this stakeholder analysis when structuring and executing deals? And was it particularly important in this case?
I think in every deal, if you want to be successful, you have to put yourself in the shoes of your counterparty and think what really are important for them. In this particular transaction, it was unusual because the government by that time had spent billions of dollars to bail out this bank. And those were taxpayers' money. And the reason that the deal received so much attention, public attention, and media attention at the time was reported in all major newspapers, Western and Korean newspapers, almost on a daily basis or from time to time. It was because so much taxpayers' money was involved, was put into this failed bank. And of course, many other stakeholders were involved. For example, the bank substantially cut its payroll during the crisis, and all the employees took a severe pay cut. So they all suffered through this crisis, and we had to structure a deal that would make everybody, if not completely happy, but at least better off than before the transaction. And if you couldn't do it, then you would have no idea where resistance would come from. And that would derail the transaction. So I suppose there was a necessity to consider the interests of different parties, but there's also empathy. I really felt, we really felt for the government and for the employees and for the public. This was a very unusual time in the history of South Korea. This was the worst economic crisis since after the Korean War. And I'll tell you how bad the situation was. In 1997, when the Asian financial crisis started, the stock market of Korea went into a tailspin. By the end of the year, the stock market value lost 49%. Half of its value was wiped out. But that was not the worst. Korean currency, Korean won, lost 65.9% of its value against US dollars, two-thirds wiped out by the crisis. The foreign exchange reserves, the government coffers of foreign currencies, diminished, came down to $8.9 billion. Now, Korea is the 10th largest economy in the world, the OECD economy. It is now, it was then. $8.9 billion. To put it into perspective, my firm, PAG, manages $40 billion. It's just a firm, private equity firm today, right? For a 10th largest economy in the world to have only less than $9 billion left in its foreign exchange reserves was a huge crisis. So that was when IMF, International Monetary Fund, the World Bank had to come in to provide a rescue package in the amount of $58 billion to the Korean government so that the government could meet the obligations of its foreign debt. And that was how bad the situation was. The IMF's bailout rescue package had a condition, and that is they had to sell one of the failed banks to a foreign investor on the grounds that foreign investors will be able to bring in the needed credit culture and the needed international best practices to help restructure the banking system in Korea. So the Korean government didn't voluntarily try to bring in foreign investors. And prior to that time, the Korean market, especially financial services, was very closed. So in a way, the market was forced by the crisis to open. So Korean citizens at the time were encouraged to sell their jewelry and gold to help replenish the government's coffers, foreign exchange reserves. And that is why this deal received so much public attention. You really feel for the Korean people. And, a combination of empathy, empathy with the necessity of making sure that everybody is supportive of the transaction, at least the majority of people supporting the transaction, made it just necessary for us to consider interests of all parties.
That's a great answer. And in the book, after the consummation of the transaction, you do see how critical the employees were in affecting the turnaround strategy.
Exactly.
It's a great point. You dedicated Money Games to your limited partners, and I was wondering what lesson learned or insight you'd want global LPs, perhaps even those who haven't yet invested in Asian private equity, to take away from the book.
I think that private equity can certainly be a force for good. It brings not only capital, but the real means by which private equity creates value is to improve the operation of the investing company, to turn it around, and that's how you add value. And I think that's a very important lesson. And today, private equity is very important as a player in almost all major economies. In the United States, for example, there are more companies controlled by private equity than all the listed companies on public stock exchanges. Do you know that, Mike?
Yes, yes. Yeah, in
So,
fact, you have some figures in your book that make the point too.
right. So it has become very significant. But it is also somewhat controversial. Some people point to the fact that some private equity investors make money by stripping assets, dividending themselves by borrowing too much money, cutting costs maybe too excessively. I think things like that do happen. But by and large, private equity makes money by creating value. And my story, I think, underscores it. And from the point of view of limited partners, to which this book is dedicated to, they have to realize that we work for them as GPs, general partners, as private equity firms. And the kind of process that we go through to make sure that we safeguard their money, we generate good returns for their capital. Sometimes people think that private equity is big boys or big girls game involving large institutions. But if you look through your limited partners, many of which are pension funds, sovereign wealth funds, and the money comes from taxpayers, money comes from pensioners, small pensioners. So everybody has the interest in this particular game. And they will have to understand how the money is actually made. Another lesson is, economic crisis is a time when many investors stay away from the market. But if you know what you're doing, the economic crisis is very often the best time to make investments.
Yeah, such a great answer. And I must confess that I am one of those who is fairly critical of the leveraged buyout model when it is practiced in a way that is extractive. But one of the core beliefs that I have is that private equity, when done well, can do exactly what you said, is lift the boat for many people, do well for investors, the fund manager, but also the company and society writ large through positive externalities. And this transaction in money games is a great example of it. I do want to pick up on the comment that you left at the end there on these periods of crises when private equity investors can come into the game. And the latest figures from the Bank for International Settlements that I've seen suggest that the total credit to the non-financial corporates is about $30 trillion across China, Japan, and Korea, with China's figure about 160% of GDP, whilst Japan and Korea's are at about 105%, and that's compared to 80% of GDP in the US. And I'm wondering what compelled you to write this book now? Are you anticipating a wave of bank or corporate restructurings in Asia?
I'm actually not quite sure if your numbers are correct. I listened to your numbers, but I wonder if they add up, because China's GDP is $15 trillion. Japan is just about 1/3 that of China. So you add that, you add about $5 trillion on top of that, and that's the same as the size of the U.S. GDP, about $20 trillion. Purchasing power parity basis, of course, the Chinese economic size today is about $28 trillion. So the percentages that you cited are probably not accurate, at least to my mind, because I don't feel that there's over leverage in the corporate sector in China. And of course, I don't think that there's over leverage in the corporate sector in the United States. However, private equity very often takes on too much debt, which is not a problem until there's economic crisis. Until today, we're in the middle of global economic crisis, with the exception of China, which is probably the only major country to register positive growth this year. In the economic crisis, if you have too much debt, then you're in trouble. And I think a number of portfolio companies of private equity firms are in trouble, especially in the retail sector, in hospitality sector, because of too much leverage. So I think a big lesson to be learned from all of this crisis is that you have to be conservative with regard to leverage, because leverage can help you, but it can also kill you. May I expand on this particular subject about leverage, Mike?
Absolutely. Please go for it.
Okay, so let's look at how Korea got into the crisis, which gave rise to the opportunity for us to buy what used to be the largest bank over there. When we arrived in Seoul to negotiate the transaction, what I discovered was that the average debt to equity ratio for corporates in Korea at that time was 300%. 300% compared with the average of about 78% for American firms. And it was such a big difference at the time. And there were 15 large chaebols or conglomerates in Korea at the time, including Daewoo, Samsung, Hyundai, LG, and so forth. On average, for chaebols, the debt equity ratio was 500%. And that's how so many of them failed. For example, Hanbo Steel failed, Kia Motors failed, which brought down the banking system. About 150 banks failed during that period of time. Korea was growing very rapidly on borrowed money. But when the crisis came, of course, it failed many banks, it failed the economy. And since then, Korean banks recapitalized themselves, and the debt equity ratio came down quite substantially. And now, if you look at the Asian financial crisis, many banks failed. In Korea, in Japan, in Southeast Asia, including Indonesia. Then in 2008, many American banks failed. Lehman Brothers, of course, Bear Stearns, and so forth. But we are not aware of any major bank in Asia which failed in 2008, right? The 2008 crisis was considered to be a global financial crisis. American banks failed, European banks failed, but not Asian banks. The reason is that Asian banks all learned a lesson from the Asian financial crisis 10 years prior, and therefore, when 2008 came, all their banks were very well capitalized with adequate reserve ratios, and the societal debt to equity ratio came down quite substantially. Fast forward from 2008 to today, we're in the economic crisis. How many American banks are in trouble? How many European banks are in trouble? Almost none. You can't think of anyone in trouble. In fact, banks are making extraordinary returns. I mean, they're making a lot of money. Their earnings are up. Why is the case? If this pandemic had happened in 2008, all the banks would be in even deeper trouble than what happened to them in 2008. And now they're spared of trouble because they took a lesson from 2008, and regulators took a lesson from 2008, and all the banks are now well capitalized, and their risk management is very much strengthened, and their reserve ratios are increased so much that when the crisis comes, they're in very good shape. So I think you have raised a very good point, and that can propel economic growth for an economy, for a firm, and for banks, of course, but it could also kill them, because economies go up and down, and you have to be prepared for a rainy day like we're experiencing right now. The big question is whether or not there is a debt problem with the Chinese economy. And somebody just asked me this question yesterday. I don't think there is systemic risk. And if you think about what really brought down the banking system in the United States in 2008, it was the housing crisis and it was the mortgage crisis. Banks lent to citizens to buy houses, and the debt to equity ratio was as high as maybe 90%, right? We call it loan to value ratio. The loan to house value ratio was as high as 90%. So when the housing price came down 30%, of course, many homeowners defaulted and banks failed. And if you look at today in China, housing loans represent probably the biggest portion of the loan exposure for banks. On average, loan to value ratio is about 50%, about 50%. And therefore, even if the housing price comes down 30%, it wouldn't affect the banks. It wouldn't cause systemic risk. Furthermore, there is a difference in the Chinese system as in the United States. In the United States, if the value of your home is less than the value of your loan, many people will simply walk away from their home because there's nothing left for them and the liability is limited. So many people did walk away from their homes. There were foreclosures and so forth, and banks couldn't recover their money. In Asia, in most countries, I live in Hong Kong, the rule is that a housing loan is a personal liability. So you can't walk away from it. If you walk away from your home, you still have to pay the loan. And therefore, in 97, 98, Asian financial crisis, many homeowners experienced negative equity. That is, their home value is lower than the loan value, but almost no default, because wherever people went, they still had to pay back the loan. And therefore, the system prevents a housing crisis like what we experienced in the United States in 2008. In China, it's the same system. A home loan is personal liability, and therefore, I don't think there's that problem in the Chinese economy.
Very interesting. I'd love to ask you a question about China specifically. I'm not sure if you're familiar with him, but Michael Pettis, who's a professor at Peking University, and he's written several books,
Yes.
most recently Trade Wars, Our Class Wars. He asserts that an effective rebalancing of China's economy requires a transfer of wealth from SOEs and local governments primarily and toward households. And he mentions that the challenges are one, that the reliance upon debt financed investments to attain GDP growth targets is fairly ingrained and might inhibit these reforms. And two, he recently pointed out that trade data show that China's economic recovery from COVID-19 has been driven by the supply side, with exports up 20%, give or take, year over year in dollar terms, with imports only up about 4%. And I wonder, one, do you agree with his assessment? And two, if so, what are the prospects that China will successfully affect this transfer of wealth and its rebalancing efforts?
I only partially agree with him, and I certainly don't agree with his views on exports. The Chinese exports didn't go up 21% this year. It went up 21% year over year in November of this year.
Correct.
But
yes.
Year to date, it has gone up about 2.3%. Imports dropped slightly by 1.4%. So Yes, in the past few months, the Chinese exports have grown very strong. In July, it was 7.2%. In August, 9.5%. In September, 9.9%. In October, 11.4%. And then last month, 21.1% growth over the same period of last year. But all the 11 months combined is only 2.3%.
Mm, mm-hmm.
China is actually shifting away from an export-led growth. Uh, at its peak, exports used to represent 36% of GDP. Today, it's only 17%. I think the export is so strong this year because other countries have experienced much more severe lockdown after the second quarter.
Mm.
China basically eradicated the virus starting from April. There have been almost zero cases since April. So China is producing, whereas other countries are not producing as much. And I think this kind of growth in exports will not be sustainable. And that part, I agree. But with regard to SOEs, I think state-owned companies, I think they remain too big. They represent about 25% of the GDP, whereas the private sector 75%. But SOEs are efficient and they are wasteful in use of resources. So I think to sustain China's economic growth, uh, China should continue to reform the state-owned sector, privatizing them, and which has been the policy of China's economic reforms for 30 years until probably recently. And I think it's very important for China to do so. When we talk about rebalancing, and China's economic growth has been driven by investments, which for many years represent about 45% of GDP. No other country at any time in history, at any stage in their industrialization process, has invested close to 35% of GDP. But China has been doing 45% year after year after year for the past 10, 20 years. And China is able to invest so much because China uniquely has the highest savings rate in the world, 50% of GDP. But that savings rate is not sustainable. The Chinese population will age precipitously in the next 10, 20 years
Yes.
when people of my generation retire. And that is because the next generation is much smaller. In my generation, on average, a family has 3 siblings. Next generation, 1, due to one-child policy. So China will not be able to invest so much in the next 10, 20 years. So it will have to shift its growth model. In which direction? Private consumption. Private consumption represents today about 39% of Chinese GDP, compared with 68% for the United States.
Mm-hmm.
But 5 years ago, China's private consumption only represented about 35% of GDP. So there's a lot of room to grow. 10 years ago, China's retail goods market was $1.8 trillion. This was in 2009. For the United States, the corresponding number was $4 trillion. So America's retail goods market in 2009 was more than twice the size of China. In 2019, last year, China's retail goods market was $6 trillion compared with $5.5 trillion for the United States. So it's already larger than the United States. This year, it will be even larger than the United States. So China is definitely shifting in the direction of private consumption, and the growth in the future will be more driven by private consumption as opposed to be driven by investments. If China is not able to make that shift, then growth is going to stall.
Yeah, great answer. All right, I want to bring it back to money games and sort of wrap up our conversation with a few more questions. One of the charming anecdotes in your book relates to the serendipity of your transition to private equity, with David Bonderman saying you were quote unquote clueless about private equity, but he liked your personality and he thought you could learn. The industry has become much more institutionalized since then. What advice would you have for younger people who wish to build a career in private markets, be that in Asia or elsewhere?
You're absolutely right that the industry has become much more institutionalized today than, say, 20 years ago. See, in the United States, you would find major private equity players are always associated with some very famous personalities. For example, David Bonderman for TPG, Henry Kravitz for KKR, Steve Schwarzman for Blackstone, and so forth. David Rubenstein for Carlyle. But you don't see the same association with strong personalities in Europe. Can you name some very well-known private equity players, persons in Europe? Hardly. And nor do you see that so much in Asia, because private equity was really invented in the United States, and there were some very talented people who got into private equity, built a business for themselves and then for the industry. And that's why these people became very famous. But as they retire or as they build the business to become larger, they have become more and more institutionalized, even though many of the institutions continue to be associated with the names of the founders. Now, when private equity went to Europe and Asia, of course, very often they were just started by American firms. Like Newbridge was started by TPG. And so we began to institutionalize the ways we do things from very beginning. It's through the committee. It's through a process that we make decisions. So I think it's a very good thing. And then you will see a long runway for private equity because institutions can live forever, whereas personalities don't. For younger people, I think it's critically important to have the relevant experiences in order to be successful in private equity. We typically don't hire from among college graduates. We hire from investment banks. The analyst program of investment banks is great training ground for analysts, for associates who can build models, who can do rigorous quantitative analysis. But I think the most important quality in private equity, to be successful in private equity, is not only hardworking. Everybody would have to work very hard, but to be able to make right decisions, to make right judgment, to know that there's a good deal when there is a good deal. And how do you do that? Of course, you can't make right decisions if you don't know about that business, if you have no experience in making this kind of a judgment. So experiences are important, but continued learning is critically important. David Bonderman likes to say, we live to learn. And that's the only way. You keep learning, you keep accumulating knowledge, you keep getting experiences, and that's how you become successful.
Great answer. All right. And at the end of Money Games, you sneak in a reference to an investment in Shenzhen Development Bank. Should we be expecting a new book from you next year?
That would be too soon. I think I have to I have to space out my books. I published Out of the Gobi last year, and I published Money Games this year, and I already feel that the time difference between the two is too small, and people are still reading my first book. So, but I am working on the third book. Anytime, I certainly will like to have it published. My job is to make investments on behalf of our limited partners, our investors. So I only do some writing in my spare time, like the weekends. So I can't do it very quickly anyway.
Excellent, excellent. Well, Shan, this has been a genuine delight.
And thank you so very much for having me and for your very good questions.
My pleasure, Shan. Hey everyone, this is Mike again. Thank you for listening. I hope you found the conversation edifying, and if you have any feedback, good or bad, please send me an email at mike@porticoadvisors.com. If you like this episode, please share it with a friend, colleague, or your connections on social media. Or, if you feel like it, leave us a review on your podcast player of choice. If you're keen to learn more about private markets developments across the emerging markets, then go ahead and smash the subscribe button, and please visit our website, porticoadvisors.com. That's porticoadvisers.com, where you can peruse through our research and newsletter archives and sign up for our monthly-ish newsletter. Ciao for now. The discussion in this podcast is for informational purposes only. Neither Portico Advisors LLC nor its guests plan to update this material, and the opinions and conclusions mentioned may change without notice. Neither Portico Advisors LLC nor its guests make any warranty that the information in this podcast is error-free, omission-free, complete, accurate, or reliable. Nothing contained in this podcast should be construed as legal, tax, securities, or investment advice.